Good morning and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, January 28th, 2020. We're starting another Fed meeting today. Looking forward to seeing what the Fed has to say tomorrow, given the coronavirus outbreak, see whether or not they may want to tap on the brakes, maybe even lower rates. Who knows? I wouldn't be shocked, but we'll see what happens tomorrow. As far as the rest of the action yesterday, I tell you, it was not a great day. We're going to get into all of that in just a minute or so, but let's go through today's agenda for you. We're going to start off with that daily market recap. I'll go into talking technically. I'm going to look a little bit at relative strength today on the various sectors. I know I've talked recently about the fact that we've seen the defensive areas outperform on a relative basis, and I don't like to see that, but I want to see, in order to call it a significant top, we'd want to see this relative strength of defensive groups continue as the S&P 500 continues to try to go higher. We've seen a little bit of that lately, but if that continues, that would obviously be a problem. We'll talk about that a little bit. Earnings spotlight starting to pick up. A lot of earnings coming out. It'll really pick up later today. We get a big report from Apple after the bell, but a number of big names, big technology names will be out over the next few days. And of course, earnings season in general will pick up considerably over the next couple of weeks. Then we'll get into upgrades, downgrades, candlesticks. I want to talk a little bit about candlesticks. Anyone who follows me knows that I use candlesticks all the time. Outside of probably price volume, the combination of price and volume, I think candlesticks would probably rank right up there as probably the most important for me. And then I'll get into three you must see. And today's three you must see, I'm actually going to pick those based on certain candlesticks that I liked. So we'll get into all of that throughout this show today. So let's go ahead and jump into the daily market recap. And let's take a look at what happened yesterday. Good news and bad news, the way I look at it. Obviously, the bad news is the Dow Jones Industrial Average was down 453 points. The good news is it was almost all at the open. We didn't see a lot of selling once the market opened. So it's like the market was reacting on the fears that was generated in the media, and then there really weren't a whole lot of sellers after that. Even the high to low was not that significant when you think about it. I mean, look at the S&P. The trading range during the day was not that great, considering how red the futures were. A lot of the talk about the coronavirus, which is a big deal. We don't know how big, and we don't know how it's going to impact the market longer term. But it seemed like a lot of the fears were built in at the open, and then from there on, anybody that wanted to sell, there were plenty of willing buyers. So when you look across the major indices, that's probably my first takeaway, is that, yes, it was a bad day. The market has been needing a bad day, to be honest. Actually, probably could use a few bad days. Some consolidation. Talked about, I don't know, maybe a week to 10 days ago, I wrote, I thought the market looked really toppy. And so I'm not surprised we're rolling over and we're pulling back. It was time. But the question is, what's the character of this pullback? What's the character of this consolidation? Is it simply short term, or is it going to just be confined to a very short term, maybe within a channel? Looking at the S&P 500, the channel I'm talking about is if you connect these highs and then connect these lows, nice little channel that's formed. We'd need to bounce almost off of today's low, which futures are pointing to a higher open today. So was that it? If that's it, I think we just resume the trend that we've had. And if we keep moving higher, where does the money go? Which areas of the market? That's going to be important. If it doesn't hold the lows from yesterday, then I think we could be looking at a little bit more intermediate term trouble. So we'll have to see. But all of the major indices, as you can see across the board here, were down yesterday, but most of them pretty much held where they opened. Looking at the other areas of the market, various sectors and so forth, energy continues to drop, but look at crude oil prices. I mean, it's not, this isn't rocket science. You got crude oil prices that have dropped from over $65 a barrel to 52.5. You're going to see a drop in energy prices, and that's what we've seen. Technology, It had been going straight up, finally pulled back, got a 20-day test. First time we've seen that in about 7 weeks or so. But we were down more than 2%. Technology had a rough day. Semiconductors leading that move to the downside. They've been on fire of late, but they did print a black candle, which is a reversing candle off an uptrend. And sure enough, we got that reversal yesterday. Gambling stocks also took a big hit. I think a lot of this has to do with the coronavirus fears, but you can see that the index actually was primed for a pullback anyway, in my view. Higher prices, lower PPO, and we've moved down. Now, I would have thought the 50-day, but we've actually moved down a little bit below that. Probably want to watch these lows. There was a gap support and a couple of tests of it back in November, December. I'm going to say right around 825, 830. I'd like to see the gambling stocks hold there. 10-year Treasury yield, we actually had, actually, I didn't go back and check to see the durable goods report. Maybe I can pull that up for you here in just 1 second. But as you look at the 10-year Treasury yield, you can see that we are higher. Let me get an update on that, make sure we got the latest there. Yeah, so right now we're up 1.5 basis points to 1.62%. And trying to get these durable goods up here, give me that latest number. This was out at 8:30 this morning. One of the problems, though, that I have with the market is this uptrend has broken in January. Now, again, in the recent secular bear markets, 2000 to 2003, and then 2007 to 2009, if I had seen this kind of action, I think we would have seen a stock market. If we had been going down for a month like this, 5 weeks, the stock market would have been getting pounded throughout the 5 weeks. That has not happened. So what's been happening is a lot of new money's coming into the market. Much of it's finding its way into the equity market. Some of it apparently continuing to find its way into the Treasury market. So there's still a lot of nervousness out there, which is sending the yields lower. Personally, I think a lot of this has to do with the fact that the inflation numbers are so low. I think that the Fed has room to lower if they want because of inflation being below target levels. Normally, when the economy is strengthening, you don't want to lower rates because that just adds to the overheating the economy, inflation, commodity prices take off. That's not been the case this time. We're seeing the moderate growth, but we're not getting the movement up in commodity prices. I think part of that is some of the foreign markets are not performing as well as the U.S., although some of that's beginning to change a little bit. So we'll have to see how things progress in 2020. The durable goods orders came out at 8:30, and a pretty strong report. New orders, 2.4% rise. Market was only expected 0.5%. However, if we strip out transports, it was actually a decline of 0.1%. The market was looking for a rise of 0.2. So a little bit of a mixed report. So far, 10-year Treasury yield bouncing. That's good. That's good news. That's a good thing. We've got money rotating out of Treasuries finally after going straight down for the last week or so. So this is at least short term, a little bit of better news to see the 10-year Treasury yield rising a bit. All right, let's move on to talking technically. I pulled up this S&P 500 chart, and this goes back 12 years. So it goes back to the start of the bull market and into the end of that prior secular bear market. And what I have here is the S&P going up as a weekly chart. And then underneath, here's the technology group relative to the S&P 500. Now, if you're thinking, okay, we're going to have a recession out there, technology companies, they're fast growers. They would be companies that would be getting hit. Market would be anticipating that. We're not seeing that at all. In fact, when we had a little bit of a blip back in the fourth quarter of 2018, that's when the growth slowed. If you recall, GDP, I think, went from 2.5% down to about 1.1%. That's when technology got hit on a relative basis. Since then, it has been straight up, and I'm not seeing much of a slowdown here. Now, this has got two implications, really. Number one is I think it speaks to a very strong economy going forward. If the market was looking ahead, didn't like what it was seeing, technology would not be acting like this on a relative basis. The other implication, though, is because technology has been so strong and outperforming the S&P 500, they haven't really left much for everyone else to outperform. when you've got one of the biggest areas of the S&P 500 just crushing the S&P, then it's going to be difficult for other areas of the market to outperform. And I think that's what we've kind of seen. I mean, the consumer discretionary did okay, but it pulled back since beginning of the fourth quarter. Communication services, and by the way, the XLY still looks good to me. Higher highs and higher lows on a relative basis. We're uptrending. Communication services, same thing. We're uptrending on a relative basis, but we're kind of just going along for the ride, which isn't a bad ride, by the way. The S&P's been doing extremely well. Industrials have been down a little bit over the last couple of years, and it's mostly because of transports. They've a couple of times they've started to get going. They really took a hit because of the coronavirus. Airlines were hit pretty big yesterday. And so I still see an uptrend here. I think we've still got an uptrend in play. I wouldn't want to see these recent lows violated. That's about where we broke out from previously. So we're at a level we need to watch. I think financials also are in an uptrend from this low. I think we have been putting in these higher lows. Would not be surprised to see this move higher, but we're going to need some cooperation from Treasury yields to get the financials going again. Fourth quarter looked pretty good. They've been pulling back again since. Healthcare, I think, just sideways consolidating the last few years on a relative basis. You can see equal highs, you can see equal lows, trying to figure out where we're going to go there. I suspect eventually we'll make a breakout there. Now, this is where things get interesting. Now we're into the defensive groups. What I want you to look at here is that defensive stocks, when the market consolidates or when it sells off, if you're in a bear market, look back to the end of the bear market. You can see the utilities were surging, real estate higher on a relative basis, consumer staples higher. But when you get into bull market mode, the majority of these areas of the market are going to struggle. They're not going to outperform. And I think that's pretty much what you see throughout. Now, real estate had a pretty strong move through 2012 through 2013, mostly sideways since. Consumer staples weren't bad on a relative basis. Most of this pickup, though, was when we consolidated 2014 and 2015. So the market got fearful. You can see consumer staples did well, real estate did well, utilities did well. But then you get into a really good market, 2016 into the middle of 2018, and you can see staples down, real estate down, utilities down. We go into a 2-year consolidation, 2018, probably middle of 2018 through most of 2019 until we finally broke out in the fourth quarter. And you can see utilities were leading, real estate was leading, consumer staples leading. Since we topped in the fourth quarter in these three defensive groups on a relative basis, that's when the market's taken off to the upside. Now what we're seeing, though, and this is what I've referred to, and this is why I was getting a little nervous about the market, is that the early part of January was being led back by defensive groups. And you can see all of them turning up. Now, none of them broken out. That's what I would be worried about. If the S&P breaks out and the utilities and real estate break out with it, that would be a concern. But I'm looking at this from a technical perspective and looking at the foundation and the fundamentals of this rally, and I think it's still intact. I think the market's going higher. But we certainly could use a pullback, and I think that's what we started last week and again yesterday. And the real question to me is this just going to be a short-term pullback, or is it going to be something a little deeper, a little bit more intermediate? I am open to either one. I'm going to watch the market and let the market tell me which one it is. All right, let's move on. And I'm going to start with, let's go into the earnings spotlight. And I'm going to pull up a stock here. This is a company that reported yesterday. They just matched. Let's go into the relative charts here. You can see that ELS, it's one of the REITs. It's been a pretty strong REIT relative to its peer group, but because real estate's been getting hit the last few months, you can see on a relative basis, this has not been a very good area of the market until just the last couple of weeks. So ELS has been picking back up again relative to the S&P, as you can see there, and it's going along for the ride with this bounce in the group, but it has been one of the better stocks. So it's still in a nice uptrend. Earnings just matched 52 cents, nothing big there. I don't know. I expect we'll probably just see more consolidation here. Here's a company that is doing pretty well in pre-market, GGG, Graco. They beat on their bottom line, 48 cents versus 39. Stock is up about 5.5% in pre-market. And the last 3 months has been pretty kind to the stock. On a relative basis, it's been outperforming its industrial machinery peers heading into this earnings report. The group itself had broken out, even though we'd seen a pullback recently. I'm not too surprised by this. We really need to get a breakout above about 53.5. That's where that double top comes in. I'm going to take this back, see if that's a big cup. Yeah, it looks like an uptrend and a nice little cup here, pulling back. So breakout above 53 would measure up probably another $10. Couple of stocks that reported after the bell yesterday, and these were a couple I talked about with our Earnings Beats members last night. We had a webinar, and it was specifically about the earnings reports, Q4 earnings, and one of them was Juniper. And I said I didn't like the chart. If you look at this chart, pull it up on a relative basis. First of all, look at it's in the telecom equipment group. Telecom is way down from where it had this double top back in April and July. So on a relative basis, this has been an area of the market that Wall Street has not liked. Furthermore, Juniper is near a 52-week low relative to that group. So Wall Street doesn't like the group, and Juniper is one of the worst performers in the group. So they came out and they matched expectations, 58 cents. I mean, the report was okay, nothing great. And the stock's down 1% in pre-market. How about F5, same space? So you got F5, there's your telecom equipment again. Here's F5 on a relative basis, down near 52-week low. Looks very similar to Juniper. This kind of a chart does not excite me going into earnings. F5 did beat on their bottom line, 255 versus 243, but the stock is down 3% pre-market. So it looks to go down probably about another $4. And it closed at 132.50. That'd be 128.50 below all of these lows. Certainly seems like it's heading back for that 122 area from August. This morning, let's talk about some earnings that came out this morning. Pfizer. I did not like this one going into earnings, and I think you will see on the chart why. If I get this chart to come up. Let me try it over here. All right, unable to get the chart. Well, I can tell you while we're waiting for the chart to come up. Pfizer did come in with a slight, actually I'm showing a slight beat, but I thought it was a miss. There's the chart, by the way. Let's take a look at the relative strength. All right, on a relative strength basis, look at Pfizer relative to the pharmas. So yeah, pharma's had a big run. And when you look at the absolute chart, you say, wow, Pfizer's having a really good run. But it's nowhere near its 52-week high. And I would argue a lot of this run to the upside, I'm not sure it was accompanied by a whole lot of great volume. And then to be down near its 52-week relative low to peers, and even though pharmas have had a big run, they've come off the bottom versus the S&P 500, but I would say overall, they're still in a downtrend. So it's an okay group, not a great group, and then one of the worst stocks in the group. So the stock is down 2% in pre-market. I'm not surprised. And I pulled up last night for our members. I mean, if I was looking in pharmas, much better looking stock would be Eli Lilly, which has been trending up, breaking out. And look at the relative strength here. I would expect a much better report on Eli Lilly than on Pfizer. All right, McCormick's getting hit a little bit this morning, down 7.3% in pre-market. Food products has been going up. You know, McCormick's, this wasn't horrible. I mean, it's been going sideways probably for 7 or 8 months. So I wouldn't call it a leader, but it certainly is not near a 52-week low either. But they missed on their bottom line, $1.61 versus $1.63, and again, down 7.3% in pre-market after just moving to a new high. 7% times 170, what is that, about $13, $12, $13? So we're looking at possibly a low. I'd watch this I'll give you the number I'd watch. If it opens at or above 160, 172, I think it's got a better than 50-50 chance to recover. If it opens below that number, I'd be careful. All right, let's see some others here. Xerox. Xerox is an interesting one. I'm going to pull Xerox up first on a long-term chart. If we go back and look at a long-term monthly chart, you can see Xerox making a big move above these prior highs. And if you look at the weekly chart, easily taking out these highs. So it's finally moving to about a 10 or 11 year high. It's challenging these highs. I'm going to go back even further. Let's go back 25 years and see what this looks like. Yeah, I mean, a break above $40 would be the first such move since year 2000, 20 years ago. And I remember this drop in Xerox, huge drop, $130 down to 5 or 6, whatever it was. It's taken 19 years for it to get back to this reaction high and try to get back through $40. So Xerox, by the way, is up 4.5% pre-market. So if we look at where we finished, that would be, I don't know, maybe $1.50, something like that, $1.60. So that's going to take us maybe 36.60, 36.70. We're going to be up, maybe challenging that 50 days. So I think we're still in this sideways consolidation, but don't lose sight of Xerox. If it breaks above 40, that would be a really significant breakout for the stock. All right. 3M. Got to bring up 3M. Maybe this will be the last one for today. 3M. I had written about it on I think it was in my Trading Places blog article. I said Apple will beat. Apple reports after the bell, by the way. And I said 3M will miss. 3M came in with $1.95. Wall Street was expecting $2.10. The reason I didn't like it, look at the stock performing relative to its peers, down near 52-week low, and of not a great group. So you got not a great group and one of the worst stocks within the group. Wall Street's telling us to avoid it. So that usually tells me the numbers aren't going to be very good, and they weren't. I think revenue matched, but bottom line fell short. 15 cents, that was a pretty big miss. Stock's down almost 2% in pre-market. All right, let's move on to upgrades and downgrades. First upgrade today that I want to go over is Canopy Growth, CGC. Going to go through just a couple of these real quick. I actually like this pullback here to test. This is an area I'd watch pretty closely on CGC. It's starting to show some relative strength. I like the volume trends coming in. This is an area it broke out from. I'd like to see it reverse from where it is today. One downgrade I'll give you really quickly is DDD, which is 3D Systems. I actually, on a downgrade, I don't really agree with this downgrade. I like the volume coming in. I like this character change on the chart. Going from downtrending, sideways consolidation, big volume, looks to me like it's starting to turn back to the upside. I think any kind of a move back down around that 1050, 1060 area presents pretty nice opportunity. So that, to me, would be an opportunity maybe to get in. All right, let's go ahead and keep moving. I want to go into candlesticks today and just talk a little bit about candlesticks. The first candlestick I want to show you is a hammer. And a hammer is a reversing candle off of a downtrend. So you can see Leggett and Platt moving down here September, October. Look at that right at the bottom. That is a hammer where you open, you continue to move lower during the day. That long tail tells you you went a lot lower intraday, but you reversed and came all the way back up and closed at the high. And if you look at it, it just kind of looks like a hammer, you know, with the handle coming down and then that little hammer at the top. That's the body. That's the open and the close up near the high with a much lower intraday low. Off of a downtrend, a lot of times that will establish a reversal. Another chart another one I was going to show you here is the piercing candle. So on the same chart, you can see how we were going down for 6 weeks. Right at the bottom here, this is almost a bullish engulfing candle. A bullish engulfing candle is one where your open and your close represents this big hollow candle that completely engulfs the prior day. You can see this one came up just short. When they come up just short, that's called a dark cloud, or excuse me, a piercing candle. So there's a couple of different reversals there. Let's take a look at another bullish candle, which would be the bullish engulfing. And I'll show you this one on Akamai. Akamai just recently, in right here in mid-December, off of this downtrend, you can see right here that engulfing candle, that huge candle that engulfs the prior day candle body. And if I look long enough, I'd probably see some others on here as well. But anytime you see a candle that completely engulfs the prior day, that's a good thing. All right, especially off of a downtrend. So let's take a look at a couple of the negative or more bearish candles. I'll try to go through these pretty quickly. Shooting star, UTHR. Look at this candle over here. You got a nice uptrend. You gap up. You're trading much higher intraday, and you come back down and go to a low or close down, close to the low. That is a shooting star. It's almost opposite of a hammer. And normally you see weakness after that. How about a bearish engulfing candle? AMKR. Look at this candle right here. Nice uptrend. Look at that, completely engulfing. And you see what happens after that. Stock's down for the next 5 days. It gets the 50-day test and then moves back to the upside. One other one, let's go with dark cloud cover. So dark cloud cover is kind of like the piercing, where it's not quite a bullish engulfing candle. A dark cloud cover is basically just not quite a bearish engulfing candle. So dark cloud cover, late July. This is not a great candle. I couldn't find one any better. But here, off of an uptrend, you can see the gap up, and then we come back down and close in the bottom half of that prior candle. That would be a bearish dark cloud cover candle, and then we move lower. All right, let's move into the 3 you must see, and I'm going to do this based on candlesticks. The first one I want to pull up for you is NXPI, and I'm just going to pull up just the daily chart. Don't need the relative strength, but we just talked about the hammer. Now, granted, this isn't after any kind of a lengthy downtrend, but it is at the 20-day moving average, which is pretty critical. So I would be watching this. This is in the semiconductor space. I think this pullback and potential hammer off the 20-day could be a short-term bottom on NXPI. Next up, flow. This is a bullish engulfing candle where we gap down, came back up all day yesterday. And the other thing that I wanted to point out here is that when you can get these candles to line up with support, that tends to be also strong. So right in here, this was a prior high that was cleared. And then here was your gap support. So you can see after gapping up, we went down, tested it. Here we came down, almost tested along with the 20-day. And then when we gapped down yesterday, we just about tested it again. That's the time when you want to consider getting into a stock. Why? Well, you've got limited downside. You got support pretty close by, and your target would be all the way up at 50 on sideways consolidation. So getting in near 44 gives you $6 upside, maybe $1 to the downside. But anyway, that reversal right there suggests to me that flow, we could see some additional follow through. And then the last one I had for you is Biogen. It's in the area of the market, biotechs that really have not been that strong. But this looks like a little bit of a piercing candle to me. And again, if I annotate it quickly here, you can see that right in here, this is about the area of key support. Downtrend, we got a piercing candle right off support. Biogen is one certainly to keep an eye on today. All right, that is it, the end of another day. I hope you're around to join me again on Thursday here at Trading Places when I'll do it all again. Mondays and Wednesdays, you can catch me over at Earnings Beats. You can go over there and join in for the fun. Everybody have a great day. See you on Thursday. Take care, everybody.